That is done. We are now re-recording for the bonus session. Suluman, it's your show.
Thank you. Thank you, Chris and Stephen and Brent. Thank you for inviting me here. And welcome to everybody. I hear a lot of good things about the conferences that you do and how much value your clients get out of it. And so that's really commendable. You guys are doing a great job. And thank you for having me. Just a few thoughts that I would like to share with you on tax planning and the benefits of tax planning, basically. And the perspective that we are taking today is the tax secrets of the elite and how they create generational wealth and a philanthropic legacy. Right? We know how difficult that sounds. We know whenever we talk about creating generational wealth, we dismiss it by thinking that that is something that only the ultra wealthy, uber wealthy can do, and as mere mortals, we that's off limits to us, and it's not. And so we can explore that together today. So with that, I'm gonna start and show you a few slides, and then I'll open the floor for questions.
Perfect.
Normally, this session takes about 4 hours. I know we don't have 4 hours today, so I'm going to skip. I'm going to hit the highlights and then skip a few slides. Don't feel bad. If you're really interested, I will have my information on the last slide. Plus, Chris and Brent also have my information. You can connect with them and through them connect with me. And I'll be happy to answer your questions if you're interested in the full presentation or the shorter version, which is about an hour and a half. We can do that so that you can have a better understanding. If you're interested, if you get it all in today's session, God bless you, more power to you, no problems there. Little bio on me. I practice what I preach, and so my business is also set up through trust and foundation. So the tax planning services we offer through my trust. And then we have a full service accounting firm as well, which is Tax Planning Consultants LLC. And there we tax preparation and so on. So those services are provided from there. I've been in tax industry for about 31 years, and we have a nationwide clientele. And I'm an enrolled agent, which is a designation conferred upon individuals from the IRS, which means that I'm enrolled to practice before the IRS all the way to the highest level, which is appeals. And also, because this is a federal enrollment, it allows us to practice anywhere in the United States and US held territories, as opposed to CPAs and tax attorneys who are able to practice in the state or states where they're licensed in. So when people come to us, they have experienced a certain level of success. So what we help them do is we show them strategies as to how to retain most of what they make legally. So, and there are 2 steps in doing that. Number 1, to stop the bleeding. And we're going to explore that in depth a little bit as to what that means. And also how to capture and grow your wealth, right? And when you do that, when you do this 2-step strategy, it also allows you to create generational wealth and a philanthropic legacy. There are anywhere from 74,000 to 82,000 pages in the Internal Revenue Code, which is the tax law of the land. And depending on which font size you're looking at, and it's growing, continuously. Tax laws are changing almost on a weekly, monthly basis, as you know. But there are only about 22 pages that are dedicated to tax laws pertaining to complex trusts and private foundation. And so that's what we are interested in. That's what we are going to talk about today. And these are the entities that are used for tax planning purposes. And what we're going to talk about, these laws have been on the books since 1913, since the IRS was created. And there were 2 sets of laws that were simultaneously created, 2 structures within the tax code. The 1040 tax code, which most of you are familiar with. 99+% of US taxpayers are part of that structure. It's the default tax structure. And then 1041 tax structure, which is something that you can elect to be a part of. This is the particular tax form, 1041, that IRS prescribes for complex trusts to file their tax returns. Complex trusts are independent entities that have their own tax form that they file. If you look at the top left-hand corner, there are 9 different entities mentioned here, and all of these 9 different entities have 9 different sets of rules or 9 different sets of laws that gets applied when you do this tax return. However, the only one that works really effectively and efficiently is the complex trust, which is item number 3 on this list. And so whenever we file these returns on behalf of our clients, we always check mark that box so that the IRS know that we are filing a complex trust tax return and not any of the others that are mentioned there, because the rules are so different. And so there are more than 80 different types of trusts in America. When we say trust, most people think that a trust is a trust is a trust. Not so. There are 80 different types of trusts, but IRS, to simplify everything, have divided all of these different types of trust into 3 categories, actually. It's grantor type trusts, which are mostly statutory grantor type trusts, simple trust, and complex trust. And like I said, complex trust is the one that is most effective for tax planning purposes, along with private foundations. There are almost 24 different types of tax exempt entities in America in terms of charitable organizations and foundations. But the charitable organization, the preferred charitable organization for the elite is the private foundation. So a combination of complex trust and private foundation is what creates this is the basis for this tax planning, actually. So when I started in the tax industry some 31 years ago, everybody told me that you're so fortunate that you have this opportunity to not only help yourself and your family, but your family as well. You must pay your fair share. And I always said, absolutely, yes, I agree with it. I must pay my fair share. The question is, what is my fair share? What percentage of income could be considered fair share, or what dollar amount could be considered a fair share? And I've been a student of tax law for 30 years, and I have not found this phrase, fair share, in the tax code, right? That's simply not part of the tax code, this phrase, fair share. Right. And so I said, okay, let's look at our business leaders, let's look at our political leaders, and see how they determine their fair share. Right. So I have a couple of clips here, but they're kind of long. So I'm not going to take your time. I have a gist here on a slide that I would like to present to you, just some food for thought, basically, as to how some of our political leaders have decided what their fair share is. Right. And so this first clip was about Mitt Romney, a very successful entrepreneur, CEO of Bain Capital, former governor of Massachusetts, former presidential candidate, former president of U.S. Olympics Committee, currently junior senator from the state of Utah, right? Very successful person. And when he was running for presidency back, I believe in 2008, and as always, journalists were after his life, release your tax returns, release your tax returns. And he never released his tax returns, but he did release his tax projections, income and tax projections. And in that income and tax projections, he projected that his annual income was going to be $20 million in passive income. And the tax rate that he projected was 13.9%. So a couple of interesting questions came to mind when I saw that he was CEO of Bain Capital, and he held majority shares in that company, and that income is normally treated as ordinary income. How come that is not shown on any of his projections? Why is that ordinary income is not there? So if you receive dividend incomes from any stock holdings that you have to report it on 1040. How is it possible for someone in his position to be able to not report that? And if he did report it, where did he report it, right? So that was one question that came to mind. The other one was that, based on 2019 tax table, as soon as you made $38,701, you were in 22% tax bracket. And how was it possible for somebody like him, who made $20 million in passive income, to have 13.9% projected tax rate, right? So that came to mind. And then back in 2016, when candidate Donald Trump was running for presidency, in one of the debates, Secretary Clinton brought it to the nation's attention that her investigators were looking into Mr. Trump's financial matters, and they could not find any tax returns except for the 2 years when he was applying for a casino license in the state of New Jersey for Taj Mahal. That they found tax returns because the application required him to file personal tax returns for at least 2 years with the application package. And those 2 years worth of tax returns showed zero income and zero taxes paid. How is that possible? Now, one thing I can tell you, both of these gentlemen had done nothing wrong or illegal or unlawful. Right? They played by the book, actually. If that wasn't the case, then candidate Trump would have ended up in the big house, not White House, right? That's not the case. He did become our president. Mitt Romney is our senator from Utah. And so both of these gentlemen are holding or held one of the highest offices, political offices in our country. How is that possible, right? So obviously, they have not done anything wrong. Now, a lot of you will say, hey, there's a lot of noise about former President Trump and his financial dealings. As an accountant, I can tell you what they're talking about is potentially bank fraud, but not tax fraud. What he had done, from what I've understood thus far, is that he had fudged numbers on his financial statements to make it look rosier so that he can get big loans from the banks and so that he can buy big pieces of real estate, as you know. So that's what they're after thus far. But, according to Donald Trump, IRS has been auditing him for 10 years. Now, they're very, very smart people who work for IRS. And if he would have done anything wrong, they would have found it by now. I can assure you, people that work for the IRS are cream of the crop people. So my understanding is that as far as the tax returns go, he has not done anything unkosher. He may have done something on the financial statement side, and that's what they have been talking about. But here, he has played by the rules, as per my understanding. Judge Billings' learned hand. Some of you may have heard this name before. A very, very well-respected legal scholar, legal expert. Also, he served on the U.S. Court of Appeals for the Second Circuit, so he was a judge. And he has been quoted more often by legal scholars and by the Supreme Court of the United States itself than any other lower court judge. And he once said, in America, there are two tax systems, one for the informed and one for the uninformed. Both are legal. Let that sink in for a second, right? He's saying in America, there are two tax systems, one for the informed and one for the uninformed. Both are legal, okay? Now, Here at the Wealth Builders Group, we are very fair and balanced. So we use two Republican examples, Mitt Romney and Donald Trump. Let's look at some of the Democrats, right? So here is the Clinton Family Foundation. I'm sure you have heard this name before, right? And look at the tax return that they are using here. It's a return of private foundation, 990 PF, right? What does that tell you? When you see an entity like that, 9 times out of 10, it's always preceded by complex trusts, which are 1041s, the form that I showed you before, right? 1041s or complex trusts are very, very private entities, okay? So you will never see a tax return of a complex trust in the public domain. One of the reasons why elite choose that entity is not only that it provides tax savings, not only that it provides ultimate asset protection, but it also provides anonymity and privacy to the highest extent. Right, so you'll never see that. But whenever you see a tax return that's a private foundation, and because it's a 501c3 entity, some bits and pieces of these tax returns you will find in the public domain. But 9 times out of 10, like I said, it's preceded by complex trust. Why? Because this is how the elite had created the tax structure. Right? That's how it works. So Bill and Hillary Clinton's foundation, Clinton Family Foundation, is a private foundation, who's a Democrat. Here it is, Paul and Nancy Pelosi Charitable Foundation, our current Speaker of the House, and her husband, who is a real estate developer, right? Private foundation, 990 PF. So doesn't matter if you're a Republican or Democrat or Green Party or whatever party you belong to, okay? Politicians who are part of the elite group of our country are all part of the same structure. They all play in the same sandbox, so to speak. They may be fighting over a lot of other things, but this is one thing that they all agree with and come together on, right? And benefit from, right? Let's look at business leaders, right? I'm sure you had heard before this one-liner, which is attributed to Warren Buffett. My secretary pays more taxes than I do. Chris, did you hear that before?
Yes, I've heard that before. And I also have heard that Warren Buffett gave away all of his wealth, or almost all of his wealth, to the Gates Foundation. What an honorable thing. I mean, to give up almost your entire net worth to a charitable foundation. I mean, pat him on the back. I mean, that was completely selfless, wasn't it?
First rule of capitalism, Chris, you know this better than anybody else, is don't lose your capital, right? And so we're going to explore that. You bring up an interesting point. So we're going to explore that a little bit. What does it mean to give away everything? You know, Warren Buffett is going around asking all the billionaires to give away their wealth or half of their wealth, right? Mark Zuckerberg did the same thing, and we're going to talk about it in just a second. But let's focus on Warren Buffett just for a second. Now, it doesn't mean that in dollar amount wise. What he meant was percentage wise, his tax rate is lower than his secretaries. But still it begs the question that how is that possible? One of the richest people in the world, his tax rate is lower than his secretaries, right? So something to explore and look into. Now, an interesting point to note, his father, Howard Buffett, was a lawmaker, actually. He was a congressman and from the state of Nebraska. And when he went to Congress, he learned all this firsthand because that's what's going on. So he learned it, and then he came back and implemented these rules and these laws into his family's financial life and benefited greatly from it, right? Then Bill Gates in January of 2019 said the government should require people in my position to pay significantly higher taxes, right? What an honorable thing to say, right? You think he's being altruistic about this, or he's gloating? Right? Because if you would remember, mid to late 90s, he was fighting the IRS tooth and nail. That's exactly what they were trying to do. They were trying to tax him and he was fighting them. So why now all of a sudden he's saying that he should be taxed more? And by the way, nobody's keeping him from writing big checks to IRS. They never say no, right? So if he wanted to write big checks, he can still do that. But instead of doing what he's saying, he's just talking about it, right? So he was fighting, back then, so to keep his taxes lower. But then Warren Buffett came into his life, and they are best of friends ever since. Advice came from Warren Buffett, and then all those lawsuits went away. All those issues went away. Nobody knows what happened actually, right? Because in 2000, Bill and Melinda Gates Foundation came into being, right? And right after that, all of those, all the woes that he was having went away. And by the way, on Bill and Melinda Gates Foundation's board of trustees, there are only 3 trustees. Can you guess who they are? Bill Gates, Melinda Gates, and Warren Buffett. And Warren Buffett is the one who gave the first donation to Bill and Melinda Gates Foundation, like Chris mentioned. $35 billion worth of his personal assets were donated to Bill and Melinda Gates Foundation. And what did Gates Foundation did with it? Turned around and invested it in a little-known company called Berkshire Hathaway. And you all know who is the CEO of Berkshire Hathaway? Warren Buffett, right? So it's very, very interesting how it works. Then in December,
story so many times. That is such an unreal story. Thank you for telling me.
And then in December of 2015, Priscilla Chan and Mark Zuckerberg announced that they are creating Chan and Zuckerberg Foundation, and they donated 99% of their assets, which was mostly Facebook stocks, which was valued at $45 billion with a B, right? They donated it to Chan and Zuckerberg Foundation. And not only that, he announced that going forward on an annual basis, he'll give away 99% of his wealth to this charity, right? And so question is, when the first rule of capitalism is don't lose your capital, then how is it possible? Why are the rich, why are the elite falling over each other to give away their wealth, right? That's something we need to explore. Why is it happening? And the concept of charity, when you think of charity, when you give to your church or your synagogue or your temple or your mosque or Susan Komen or Salvation Army or United Way or any charity, when you write a check to that charity, you have no control over that money at all, right? The charity that receives that check has control over that money, but you don't, right? And first rule of capitalism is don't lose your capital. Then how is it possible that all these wise, sharp business people, one of the biggest in the world and the richest in the world, are just giving away all this wealth, right? So that's something we're going to explore quickly. All right, so Buffett Childhood Fund is also a private foundation. Bill and Melinda Gates Private Foundation. Now remember, there are more than almost 24 different types of foundation. Everybody from politicians to business owners are picking this particular type of foundation, right? And that particular type of trust that we talked about, which is complex trust, right? The Gates Foundation is now one of the Berkshire's largest shareholders. That's CNN Business. We just talked about that, right? Chan Zuckerberg Foundation, also a private foundation. Mark Zuckerberg, right? Facebook's Mark Zuckerberg becomes the world's third richest person, passing Warren Buffett. After giving all their wealth, they're still the richest people in the world. How is that possible? Right? The Zuckerberg $45 billion charitable donation, that's money tips, right? They're giving billions away, not a few hundred or $1,000, billions. I joke with my friends and I say, my clients make more money by giving it away than keeping it, right? And it is true. Bezos Family Foundation, also private foundation. McKinsey, his wife that he divorced, received $36 billion in divorce settlement, actually. I tell my wife she married the wrong guy because, If she would have married Bezos, she would have got $36 billion, right? Just in divorce settlement. And she gave away 18 billion of it in one shot to her private foundation, right? And that's Washington Post. Andre Agassi, Andy Roddick, tennis superstars, all private foundations. The reason why I'm showing you all these examples is so that you understand that when I say elite, the financial elite from any walk of life that you would take have a different structure in place, our tax efficient and effective tax plan in place to help them minimize their tax liabilities legally. It just doesn't happen by wishing it. It just doesn't happen because you want it really bad. You have to elect to be in that structure, like these examples I presented to you, right? The laws are there, but you have to elect to be in it. So we are talking about creating generational wealth. And that's the primary goal, right? Because we all have only a finite amount of time on this planet. And when we move on, what do we want? We want our children, our heirs, our family to be in a better position than we were, right? And that's what it means to create generational wealth. So if you look at Carnegie's and Mellon's and Rockefellers and Kennedy's and Vanderbilt's and all of these, as quote unquote, are called old money, who have these type of entities, trusts and foundation in place, generation after generation, from which they're doing charitable work, but also growing their wealth, right? That is because they had this type of plan in place generations before, right? And all of that is now carried forward and enhanced by their next generations. And that's the same thing, same idea that you need to apply in your life, right? So what are some of the hurdles when we try to create generational wealth and a philanthropic legacy? What are some of the hurdles? So tax is number one, right? As if we were not being taxed enough. I don't know how many of you have recently looked at the Biden tax plan. Chris, have you had a chance to look at it yet?
I have not. I mean, bits and pieces of it just with these trainings, but no, I don't have a clue outside of the fact that they plan on taxing us way more than what we're being taxed now. That's all I know.
Right. So Biden didn't hide it. The funny part is he talked about it as he was running for presidency, but nobody paid attention. But then again, a few days ago, he had a State of the Union speech before both houses, and he made it clear he wants the income tax rate to be increased to Bush era tax rate, which is 39%, 39.6%. Sorry, it is at 37% right now. There are many other things, but one of the things that I want to talk about today, which pertains to you, Chris, and everybody that you work with and train, is capital gains tax.
Yeah, it's going up.
Yeah, and to what extent? Going up, yes, but to what extent?
To the moon.
You got it. And what does that mean in terms of numbers? 39.6%. He wants to tax capital gains. And I'm not talking about short-term. Short-term capital gains have always been taxed at ordinary tax rate, right? I'm talking about long-term capital gains tax, which normally was taxed in terms of real estate and whatnot at the rate of 20%. Now he wants to tax capital gains at the ordinary tax level. So if you are at the highest tax level, which is going to be 39.6%, your capital gains also will be taxed at that level. Now, it is not the law yet, but understand the likelihood of that happening. Both the houses are controlled and the presidency, all three of these institutions are controlled by a particular party right now. And I'm not talking about politics at the moment. I'm just mentioning facts, right? So you have House where you have one party that has majority. You have Senate where you have a tie, but then Vice President actually casts the tiebreaker vote, and you know how she's going to vote because she belongs to the same party. And then you have a president who has presented this tax idea to begin with, right? He's definitely going to sign it. So the likelihood is very high. I don't have a crystal ball. I don't know if it's going to become a law or not, but the likelihood of that becoming a law is very high from what we see. And so my point is this, that you need to do something about it. You need to plan for it. You can't, once the law is passed, and it's going to be very soon. How do I know that? Well, the government has been spending money like there's no tomorrow. All this helicopter cash that you see, you know, a few thousands for individuals here and families there, and all these trillions of dollars that are being printed, somebody has to pay for it. Government does not have a business to make money from and pay for these things, right? Who pays? Us, the taxpayers, right? And so somebody has to pay for it. And so when these taxes are raised, because the government is in dire need of money, then you'll be paying through your nose, right? And this is a fact, right? But even aside from that, if you look at it right now, your tax rate, right? For those of you who are from California or New York, for example, 37% is your top federal tax rate. And on top of that, in California, for example, you have 13.5% state tax rate. That's 50.5% right there. Now, there are very few states like Florida or Texas where we don't have state taxes, but that's an exception. And there are very few states. Most states have some form of state income taxes, right? And so on an average, it's about 50%. So every dollar that you make, 50% or 50 cents on every dollar is for Uncle Sam, whether you know it or not. And normally you don't know it because as soon as you earn it, you don't have to take it out. Yeah, you make quarterly, estimated payments and whatnot. But at the moment when you make the money, there's nobody there with a handout that give it to me. But as soon as January 1st hits, that tax bill is due, right? Then if you look at American Bankers Association website, and Brent talks about it too. I heard from Brent recently that they are saying that an average American household pays 34 cents on every dollar in interest. I still have the old statistic that says 30 cents, and I don't want to give people heart attacks, so I want to keep it soft, right? And so you add 50 cents on every dollar for taxes, average American household, and then you add 30 cents in interest payments, you're only left with 20 cents. In that 20 cents, you have to maintain your and your family's quality of life. And on top of that, create generational wealth and philanthropic legacy. The only thing I can say is good luck, right? How are you going to do that? Right? It's very difficult. It's very hard, right? And then on top of that, lawsuits are a way of life. We live in a very litigious society, and when you have lawsuits, depending on how good an attorney the opposition has retained, you can lose your hard-earned assets very, very quickly. Divorce is a way of life, and very, very quickly you can lose half of your stuff, right? Half of your assets. Inflation, that's the nature of fiat currency. Your liquid assets depreciate on an annual basis, and our government tells us that the average rate of that depreciation or inflation is 3%. All right. Only God knows what the reality is, but that's what they tell us, and we accept. Right. And so we don't have enough time to talk about all of them today. We're just going to focus a little bit on the tax side and see what we can do and how we can retain most of what we make, so we can pass it on to our heirs, to our families, and grow our wealth. So the first step in creating generational wealth is stop the bleeding. Well, let's look at the extent of bleeding, right? So this is your very original tax table from 1913. Back then, the IRS did not care if you were married or if you were single, right? Everybody had the same tax rate. So if you had made $20,000, up to $20,000 in 1913, you were in the lowest tax bracket of 1%. And if you had made $500,000 or more, you were in the highest tax bracket of 7%. Chris, wouldn't you kill today to have a 7% highest tax bracket?
Yeah, I was trying to reach into the screen to grab that, and I hit the screen. Yeah, I'd love to have that again.
Right? Okay. What does that mean in today's dollars? Right? This is 1913 dollars. So $20,000 back in 1913, adjusted for inflation at the rate of 3%, would equate to $517,357,000. And if you had made that much money, then you should have been in 1% tax bracket. And $500,000 or more, 500,000 back in 1913 would equate to $12,933,940, meaning $13 million. If you would have made that much or more, then you should have been in the highest tax bracket of 7%, right? Let's look at our tax table from 2019. It says that if you have made, as a single person, $9,525, or as a married couple, $19,000, then you are in 10% tax bracket. That's the lowest tax bracket, by the way. So from 1% to 10%, that's 1,000% increase, by the way, right? 1,000%. And if you have made 500,000 as a single person or 600,000 as a married couple, then you're in the highest tax bracket of 37%. So from 7% to 37%. Well, that's the tax rate. But look at the incomes. If you would have made $500,000, it should have been in 1% tax bracket based on 1913 tax table. Today, with 500,000, you're qualifying for the highest tax bracket of 37%. So not only that the tax rates have been hiked tremendously, your income floor has been dropped drastically. So now with the lowest amount of income, you're qualifying for the highest tax rate. People don't think about that. So just that marginal tax rate has gone up by 529%. But that's one side of the coin. The other side is that the income floor has been dropped so much that with the lowest amount of income adjusted for inflation we just saw, which is 500,000, you're qualifying for the highest tax rate. That's the level of bleeding we are talking about, right? So at this point, if I were to play a cruel joke on you and say, hey guys, this is the problem and I wanted to bring it to your attention. And now that you're aware, God bless you, goodbye and good luck. What options do you have? Right? You have no options. You'll still do the same thing that you have done before. You'll put together all your paperwork, you'll walk down to your CPA's office, you'll hand them over and say, hey, do your best, right? And if you keep doing the same thing over and over again with expecting different results, what do you think Einstein would think of you, right? So what is the solution, right? Let's talk about that. And also understand who actually created this structure, right? Financial elite, right? And by financial elite, we mean the leading families who are leading business in this country, the leading politicians, right? All of those powerful people, they're the ones who created this structure. Because we know that all these special interest groups have lobbyists, and all these lobbyists are the ones who actually inform our lawmakers and help them in creating these laws, right? So they're the ones who have created this structure, right? And wouldn't you agree that Nelson Rockefeller is part of that group, Rockefeller family, right? And look what he has to say. He says, the secret to success is to own nothing but control everything. The secret to success is to own nothing but control everything. Now, what we have been taught all our lives is the opposite. What we have been taught is that own, right? The barometer of success as to how successful Chris is, how successful Brent is, right? Is how much do they own? That's how we think, the mere mortals, right? How many buildings, how many pieces of real estate, how many homes, how many cars, what type of cars, right? That's what we think about. How many businesses, right? But the real wealthy, they think very differently. They say, own nothing, but control everything. So the principle that emerges from this statement is ownership versus control. And what does that mean? That means that institutionalize your wealth. When you have wealth in your personal name, right, then you are the one who is responsible for taxes. Then you are the one who is responsible for all the liabilities. But when you are not the owner, then you can't be taxed for it. Then you can't be held liable for any of those liabilities or issues, right? So institutionalize your wealth. Ownership versus control. So if you look at your tax structure, 1040 tax structure is the default tax structure, right? Whenever somebody starts to make money, nobody asks them, hey, do you want to be part of 1040 structure or 1041 structure, right? Right? We are all part of 1040 structure. That's how we all start out. That's the default structure. Well, I submit to you, if you look at Judge Billings Learned Hand's statement, there are two tax systems in America, one for the informed and one for the uninformed. Both are legal. And we just saw from Nelson Rockefeller's statement that it's based on ownership structure versus control structure. If you're an ownership type structure, then you're automatically part of the default tax structure, which is 1040 tax structure that you're all too familiar with. But if you're in the control, if you elect to be in the control type of the structure, then you're part of the 1041 structure, trust and foundation structure, right? So with that, I'm gonna skip a few slides, and I'm gonna continue to talk about solution, right? And so the solution, my friends, is a structure that the elite have been using since 1913, since the inception of IRS, right? It's a 106-year-old structure that we're talking about. And it's a combination of complex trusts and private foundations. This is what the elite use to minimize their tax liability, to be tax efficient, to be able to grow their wealth, to be able to create generational wealth, to be able to do good deeds in the society, give back, right? And so the bottom line is this. When you have a business structure, let's say it's an LLC, and you're the managing member of the LLC, right? Let's look at your budget first and see what your cash needs are to maintain your quality of life, right? That piece you have to claim on your 1040. That percentage of income flows to you as the managing member of the LLC and is reported on 1040, and you pay your fair share on that. The remainder, that is surplus, that is there to be put back in the economy in the form of investment so that you can grow it. That goes to the limited liability member, which is your business trust, right? If you have assets in the business trust, if you want to purchase the assets in the business trust, that's what you can do. The owner would be the trust, right? Then family trust. Again, you may have assets in the family trust, right? You can purchase. IBC, for example, infinite banking concept policies. I'm not sure if Chris has mentioned that to you or not. Very, very powerful tool, by the way, to exponentially grow your wealth. These are specially designed whole life policies where you have a tax-free vehicle, which is the whole life policy, inside of which you can exponentially grow your wealth. You can have it as a bank for yourself, so you don't have to borrow from the outside banks, and you can actually grow your wealth. You can have that bank as a platform for investments. So while you borrow from it, and invest for further growth, your cash value in that policy is continuously growing at the guaranteed rate. You can't beat that, right? This is how wealthy are growing their wealth. And if you have heard Brent's presentation before, he gives an excellent example of BOLI, bank-owned life insurance, right? That's a website online you can check, where you will see that all the top banks, may they be Chase or Bank of America or PNC or Wells Fargo or any of those big banks, they own billions and billions and billions of dollars worth of infinite banking concept, whole life policies, right? That's step two, actually, to exponentially grow your wealth. That's step two. When you do effective, efficient tax planning and you have surplus capital, it should be invested wisely. It should help in growing our country's economy and your family's finances as well at the same time, right? And then the last step is the private foundation. Whatever the surplus is ends up in the private family foundation, which is a 501c3 tax-exempt organization. And as opposed to foundations in the public domain, the charitable entities in the public domain, where they have to spend 85% of their collections in that year on their stated charitable objectives. Here, the rule is only 5%. It's called 5% expenditure rule. Now you know why rich are falling over each other to donate to this entity. Number one, the expenditure rule is only 5%, but more importantly, they get to keep the control over those donations, those charitable contributions to this entity. And they use it to grow their wealth, because you are actually allowed to invest these funds that come into this private foundation into anything legal that you want to. May that be real estate, stocks, bonds, mutual funds, IBC policies, precious metals, anything and everything that could help you grow the wealth of the foundation, you are allowed to invest it. And that's why rich are falling over each other to create these entities. That's the secret, right? So in this short span of time, this is all I wanted to cover today, to give you a basic idea of what is this structure actually, and how are wealthy utilizing it to grow their wealth. And always remember what Rockefeller said: own nothing, but control everything. If you look at this structure from the very beginning, from the ownership of the business through an LLC, for example, you are the managing member, you have total control over it. All the decision-making, all the incomes, all the expenses, you control it. Same goes for business trust. As a trustee, you have total control over the assets and incomes and decision-making. And that is also true of private foundation. As a trustee, again, you have total control over investments, assets, incomes, and all the decision-makings that relates to these entities. And that's how you grow your wealth, right? And you create a philanthropic legacy. So with that, I'm going to stop right here. And just to run quickly recap this presentation for you. So why create this way, right? So when you create a tax efficient structure, then basically you experience reduction in individual, federal, state, and city income taxes, right? Total avoidance of capital gains tax, total avoidance of estate and inheritance tax, absolutely no probate costs or hassles, ultimate asset protection, complete control over decision-making, income, and assets every step of the way. And it also allows for creation of generational wealth and philanthropic legacy in a tax-free environment based on the tax law, right? We're not talking about my wish from last night. This is based in the tax law, and that's what we are talking about. Very important thing to understand, right? What we do for you is we provide a complimentary service. First and foremost, we want to make sure that this is something that's a good fit for you, because this is not for everybody. Okay? So we want to make sure that it's a good fit for you. That's the first step. And you will see some benefits for having a tax structure like this in place. So what we do is we provide you with a complimentary side-by-side analysis. And so if you share your tax returns, latest file tax return with us, then we can run a side-by-side analysis with you. And then we set up a separate meeting with you where we share this with the analysis with you to see to what extent it could benefit you. All right. And then we take it from there. And if it doesn't, then we advise you to focus on growing your wealth and growing your income at the moment. And once we reach a level where it's helpful, then we are here to help. So that's one of the things I wanted to mention. Okay. How do we help? We provide comprehensive services from beginning to end. So we help facilitate creation of the governing instruments for these trusts and foundation, the trust agreements. We facilitate creation of those, and we also apply for EIN numbers with the IRS, effectively getting them registered with the IRS, and receiving an SS4 form where EIN number is issued to these entities, so the IRS knows that these entities exist, right? Then we also provide ongoing consultation. We just don't give you this beautiful binder with amazing governing instruments and wish you best of luck. We don't do that. We actually handhold and we provide ongoing consultation from two main perspectives. Number one, how to stay compliant, and number two, how to optimally utilize these entities, how to get maximum benefit out of it. And that's the most important part, because there are a lot of freedom and flexibility in this particular structure as opposed to 1040 structure. So we help you understand that and get maximum benefit out of it. And number three, we also file tax returns for you on behalf of these entities. That is our forte. So 1041 tax returns, 990 PF, also your personal tax returns and business tax returns. So all of that, we complete service from beginning to end. We provide that for all of our clients. Knowledge is power, Sir Francis Bacon. And a lesser known wise man said, taking action on knowledge is power, right? So it's all about action. You have heard what the issues are. You have heard what the solution is. Now it's time to look into it and see how beneficial it is for you. And if it is, then certainly you should take action on it. Any questions?
Yeah, there was a couple, Suluman. Someone's asking what the rough minimum monetary number would make sense to set up one of these types of options to work, maybe to work with you. Like, is there a general, like?
So that really depends. Yeah, that really depends, Stephen, on individuals and families and their total financial situations, their needs on the quality of maintenance, quality of life maintenance side versus surplus cash for investments, whatnot. So that's something that I think is better served if we have a separate meeting just with that individual and the spouse if they're also interested. And I can certainly talk in detail about that once I have a better understanding of their financial situation.
Okay, fair enough. So your contact information is all on the screen, and we can get that over in the chat as well.
Sure.
What's the easiest way? Just to email or call your office or cell? What's the best way to?
Yeah, so the best way is to shoot an email out at support@thewealthbuildersgroup.com. That's the email on the screen right now. And Zara, my amazing assistant, would certainly help you in set up a Zoom meeting, and we can get online and discuss this matters in detail. Actually, yes.
Okay, great. So support@thewealthbuildersgroup.com. Just put it over in the chat. Jade was asking, how long does it take to set up a foundation?
Okay, so once it's determined that this is an entity or this is the structure that would serve your purposes, your objectives, and once the formalities are taken care of in terms of applications, forms, stuff like that, once you get us all the details, then from that point on to create the governing instruments, it takes about 2 weeks for the team to do that.
Okay.
And after that, once these governing instruments are done, then there are certain steps that myself and my staff help you with, and complete all those steps. So all said, it takes a couple of months to complete all the steps, actually. But the governing instruments itself, it takes about 2 weeks.
Okay. Okay.
That's
Great.
that's the
So,
first step.
yeah. So, I have a feeling, we don't have a whole lot of questions coming through, which kind of tells me everyone's probably scheduling calls with you. And I know Chris had to take off real fast about 2 minutes ago, but he said he has a call scheduled with you coming up to start implementing some of this
Right.
also. So make sure you set up a call with Suluman. And sir, we really appreciate you being here. That was mind blowing stuff. I've been around this business for a long time, and it's stuff I've never even heard of before. So it's just unbelievable. And we're very thankful that you were able to come on today and educate our students. And we look forward to doing business with you in the future.
Thank you, Stephen. Thank you, Chris. Thank you, Brent. It was indeed my pleasure, and I look forward to working with you all. Thank you so much.
Yes, sir. Have a great Sunday. Thank you.
Thank you. Take care.
All right. All right, Money School. Well, that is the wrap of another powerful 3-day Money School Essentials training. So thank you all for being here. We do really appreciate it. And we look forward to the next one. Maybe you want to join us again. It seems to get better and better every single weekend. And, we brought on a few new speakers this week. Yesterday was really cool. Today was unbelievable with Suluman, and I hope you guys had a great weekend as well. So make sure you get your call scheduled or email me, snaggy@chrisnaugle.com. Let's talk about how to start implementing these strategies. I'll get that email out with everybody's information so you can contact and start taking action, and make sure you connect with Suluman, if you're at that level, or maybe just start, following Suluman and, educating yourself on different techniques. And once you start implementing the strategies we're teaching, we'll get you to that level where you can start doing things like 1041s and private foundations and family trust. It's a beautiful thing. So thanks for being here. We'll see you guys on the next one. Cheers.